Welcome back to Talk Tickers, where we break down earnings calls so you don't have to.
That's right. Today we are digging into Easterly Government Properties, that's ticker DEA. They reported Q3 2025 numbers.
Yeah, DEA, they're interesting. They focus on government lease properties, really long duration stuff.
Exactly. Mission critical facility.
So our goal today, figure out what happened. They reported pretty solid Q3 numbers, met estimates, beat slightly on revenue.
Yep.
But the stock traded down. So we need to unpack the metrics, what management said, and that forward look. Why the caution?
Okay, let's start with the results themselves. Q3 2025. Core FFO per share, $0.76. That was exactly what the street expected. Nailed it.
Okay, check one. And revenue?
Revenue was $86.15 million. That's actually up a strong 15% year over year. And it just nudged past consensus expectations, too.
So operationally, sounds like a clean quarter. Hit FFO, slight beat on revenue.
Fundamentally sound, yes. You also had GAAP net income of $1.2 million, EBITDA around $54.2 million. Solid metrics across the board.
But, and here's the rub, the market reaction wasn't solid. The shares went lower, didn't they? Down like 3%.
That's the key. They did. And on pretty heavy volume, too. Something like 1.2 million shares. Way above the average.
Right. And when you see that kind of volume on a down move after they basically hit their numbers?
It screams that investors were looking straight past Q3. Something in the commentary, or more likely the future guidance, took center stage. Execution was fine, but the story shifted.
Okay, so let's go there. If Q3 was okay, the market must have really zeroed in on the guidance, particularly for 2026. What did they actually say?
Well, two main things on guidance. First, for this year, FY 2025, they just tightened the Core FFO range slightly. Now $2.98 to $3.02 per share. No big surprise there.
Fine-tuning. Okay, so the issue must be the next year's outlook.
Exactly. They introduced the initial range for FY 2026 Core FFO, $3.05 to $3.12 per share. And that number landed a bit below where some analysts had modeled it.
Okay, so not a disaster, but maybe not the acceleration the market hoped for. Like the growth trajectory felt a little flat.
That's likely it. Management really hammered home their main goal, delivering consistent, compounding core FFO growth. They're talking 2% to 3% a year. Steady, reliable.
2 to 3%, okay.
And they pointed out the midpoint of the 2025 range already implies 3% growth over 2024. So their message is really about durability, predictability, maybe not shooting the lights out growth-wise.
Endurance over excitement, maybe, which, makes sense given their assets. We should probably touch on that portfolio quality.
Definitely. It's key to understanding them. We're talking 102 properties, over 10 million square feet, and the weighted average lease term, the WALE, is long, about 9.5 years.
And these aren't just generic office buildings. They're things like FBI field offices, federal courthouses, public health labs. Stuff the government needs.
Mission critical is the term they use, and it fits, which leads into a strategic point they discussed, diversification.
Okay, diversifying away from the feds.
Not entirely away, but adjusting the mix. Long-term, they're targeting 70% federal government tenants, 15% state and local, and interestingly, 15% what they call government adjacent.
Government adjacent, what does that mean exactly? Still high credit quality.
Yeah, essentially. Think private companies, maybe defense contractors or tech firms whose main business relies heavily on long-term government contracts. Their creditworthiness is sort of linked back to the government budget.
Got it. So it broadens the pool, but keeps that sort of government anchor. And the state and local push, why increase that?
It's all about lease duration. Federal government leases, by law, max out at 20 years. But some state leases can go for, 40 years?
30 years, wow.
Yeah, so adding more state exposure helps them lock in cash flow visibility for even longer. It boosts that internal growth profile over decades.
And we saw deals that fit this mold recently, right? Like that York Space Systems building in Colorado.
Perfect example. That's a government-adjacent tenant, heavily involved in defense and space. 138,000 square feet. They bought it for $29 million.
And the cap rate on that was interesting.
Very interesting. Low 11s. Which for government-linked real estate is quite high. It suggests they got a really good price, maybe a motivated seller situation. Shows discipline. They aren't just buying anything.
Right. They're waiting for deals that are really accretive, especially if overall growth is guided to be, modest.
Exactly. That 2-3% growth target means they have to be smart with capital.
Which brings us neatly to the balance sheet. If growth isn't the main story, management seemed to imply the real focus, the real potential value driver, is leverage.
Absolutely. Critical point from the call. They were very explicit. They are targeting a medium-term cash leverage goal of 6 times net debt to EBITDA. 6 times.
6. Okay, and historically they've run higher, right? More like 7 or 8 times.
Correct. Usually in that 7x to 8x range. So dropping to 6x is a major strategic shift.
Why now? Why the big push for 6x? Is it just about rates being higher?
It's primarily about market perception and how they stack up against peers. They know the market penalizes REITs running leverage above 7x, almost regardless of who the tenant is. To get valued more like the high-quality net lease REITs or even the better office REITs, they feel they have to hit that 6x number. It's about getting a better valuation multiple, plain and simple.
Okay, I get the goal. But getting from where they are now, you said 7.6x after the FDA payment, down to 6x in, what, 2 or 3 years? That sounds pretty aggressive, especially with slower growth. Are they planning big asset sales or something?
That's the big question, and probably why the stock reacted cautiously. Management tried to address it. They highlighted steps already taken, like that $102 million FDA Atlanta construction payment they got back in Q3. That alone brought cash leverage down from 7.9x to 7.6x.
Okay, so some of it happens organically as projects finish.
Right, and they expect it to dip below 7.5x just when that project fully completes later this year. But beyond that, they mentioned capital discipline.
Like the ATM, they use their at-the-market equity program.
Yeah, they did. Issued about 750,000 shares, raised nearly $17 million, and importantly, at a pretty decent price, over $22 a share. So not desperate selling.
Okay.
They also upsized a term loan to $200 million. And a key goal they mentioned is getting more investment-grade ratings. They have one now. They want more so they can tap the public bond market more effectively, likely get better pricing than just relying on banks.
So it's a mix. Project completions, maybe some disciplined equity issuance, improving their debt profile. It's a multi-pronged attack on that leverage number.
That's the plan they laid out. Ambitious, yes, but they seem committed to that 24, 36-month time frame for hitting 6x.
All right. Can't talk about a government landlord without bringing up the elephant in the room. Government shutdowns. Did they address that risk?
They did, and pretty directly. Management kind of brushed it off as kabuki theater, political maneuvering around budget deadlines.
Yeah, kabuki theater.
No. Their core argument, based on history, they cited 21 previous shutdowns, is that the government failing to pay rent on these absolutely essential buildings. It's basically unthinkable. It'd be like defaulting on a treasury bond.
Which isn't happening. Okay, so the rent checks keep coming.
That's the belief. They did concede that shutdowns absolutely slow things down, like getting new leases signed, design work approved, the bureaucratic gears grind to a halt, but they don't see it as a threat to the actual value of the portfolio or the long-term cash flow.
Because the buildings are just too important. Makes sense. Okay, so we have the Q3 results, the cautious 26 outlook driving the stock, and this big strategic pivot to get leverage down to 6x. Let's shift gears. Time for our not financial advice segment. Outrageous but plausible trade idea.
All right, so we've got this interesting split, right? Rock solid assets, government tenants, long leases. But the market is treating it cautiously because of that current leverage level.
Yeah, it feels like it's being punished like a regular office REIT, almost.
Exactly. It's being valued based on the balance sheet structure today, not necessarily the underlying security of the cash flows over the next decade. That disconnect is where the idea comes from.
Okay, lay it on us. What's the trade?
It's a relative value play, a paired trade. The idea is go short the general office REIT sector, maybe use an ETF like XLRE, which has been weak anyway, and go long DEA.
Short office, long DEA. Betting on a divergence. What's the catalyst for DEA to outperform?
It's that leverage reduction plan. The entire justification hinges on management actually executing and hitting that 6x target. If they do.
If they do, the market has to start looking at it differently.
Precisely. Think about net lease REITs, long leases, stable tenants, lower operational intensity. They trade at much higher multiples than generic office REITs because that cash flow is seen as way safer.
Okay.
If DEA gets its leverage down to that pure comparable 6x level and keeps delivering that steady 2-3% growth they promised, the argument is its valuation multiple should move much closer to those net lease comps. The market perception fundamentally changes.
And what kind of valuation does that imply, potentially?
Well, management commentary sometimes hints at where they think they should trade based on asset value. If it gets re-rated towards those net lease peers after hitting the leverage target, you could plausibly see price targets moving from the high 20s or low 30s up towards, say, $36 or even higher.
Wow, okay. So the paired trade hedges out general real estate risk. And you're making a specific bet that DEA management delivers on deleveraging and gets rewarded with a higher multiple.
That's the core idea. You're isolating the DEA-specific catalyst, the balance sheet transformation, against the backdrop of a potentially challenged office sector. It's a bet on execution-changing perception.
That is definitely food for thought. Okay, let's wrap this deep dive up. Key takeaway. Easterly government properties put up solid Q3 numbers.
Yep, I'm at the mark.
But the focus immediately shifted to a somewhat conservative growth outlook for 2026. And management's response: double down on balance sheet strength, making that 6x leverage target the absolute priority.
Which leaves us with a final question for you, the listener, to mull over. Considering these are ultra-long leases backed essentially by the U.S. government, is the market right now correctly pricing the risk difference between DEA and a typical office REIT, especially with borrowing costs staying high?
Is that discount for leverage justified given the tenant quality?
That valuation gap is the whole story right now.
Definitely something to consider in your own analysis. And please remember, everything we talked about today comes straight from the earnings call materials. This is just for your information to get you up to speed quickly. It is absolutely not financial advice.
Do your own homework, make your own decisions.
Thanks for tuning in to Talk Techers.
We appreciate you joining us for this deep dive.